Hi there, Etoro. It is Monday the 19th of September, and that means it's time to take a look at what moved the markets last week. Today is a holiday in the UK in observance of the Queen's funeral. So I have my children at home, so today's going to take a slightly different format, one that's a lot quicker than usual. In today's video, I'm going to look at the top 5 things, in my opinion, things that moved the market, instead of looking at the entire spectrum of things that occurred. Number 1 on the list most certainly is the US CPI number that came in last week, and this was much higher than expected, and that is a large part of what moved the markets, caused the enormous declines that we saw through last week. So the CPI number month on month was expected to come in as negative 0.1 and came in at 0.1. As you can see though from the chart, the good news is that it is definitely much lower than it has been in recent months or the recent years. If we look at the same CPI number year on year versus month on month, we can see that it is also declining, although not by as much as was expected. And if we look at that core number within the CPI index, we can see that that is holding up quite strongly, unfortunately, and this can be quite a sticky portion of inflation. So overall, fairly good news that the trend does seem to be down at a headline level, but still it is coming down a lot more slowly than the market had been expecting. And this has restoked fears that the Fed is going to continue to hike aggressively, which is bad for a large part of the market and many types of assets in the market. Now, because this was probably the most important item of the week, I'm going to spend a little bit more time on it. So if you go and look at the US Bureau of Statistics, you can see some detail behind these numbers that are published. So for example, you can see that food inflation, while declining, is still pretty damn high. Thankfully, energy has been coming down quite strongly. And outside of food and energy, inflation is still pretty strong versus the historical numbers, the historical month-to-month numbers, at least. The great thing about this particular website, created by the government, you know, first of all, that the data is going to be accurate. And second of all, they give you a number of ways to break down the data. So for example, if you wanted a more graphical view, if you are less about the tables and more about the charts, they do have that kind of option for you. So you can see across all items, inflation looks as though it's peaked, although I would say it's still a little early to call it out, but it feels like it's peaking given the fact that prices in many parts of the US economy are falling. And then you can drill into this a little bit more. So you can see that food, unfortunately, is still on the up and up, whereas energy, thankfully, seems to be trending downwards, at least for now. Now, the next day, we also got the PPI number, and CPI is a lagging indicator. It tells us what has happened, the inflation numbers historically. PPI is a bit better at telling us what might happen in the future. So this is a leading indicator. And this came in more or less in line with what was expected, and this was below 0, so this was shrinking. So by this forward-looking measure of inflation, it looks as though inflation is likely to continue dropping. While we're on the topic of inflation, we also got the UK CPI number out. The year-on-year number was actually much lower than forecast. And this keeps on happening in UK macro numbers here and there, not across the board, but we do see relative strength in the UK economy here and there. Now, we can't know if this trend is going to continue. We don't know if we've seen peak inflation in the UK, and actually given the high price of energy, I would expect inflation to stay probably around these levels for a while longer. But this was a nice surprise nonetheless. The second hot topic of the week is that we saw the worst week for US equities since June. So June is where equities put in their bottom. If you remember, there was a lot of heavy selling through June, and we can see that the NSDQ100 lost about 5.5% through the week from where it opened. The SP500, we can see also lots of red candles through the 5 trading sessions of last week. Chinese equities are not holding up much better. We can see this enormous drop, and there are a few reasons for that. One reason being that there's been some very soft economic data out of China, and also one of the very large cities has been in a lockdown for the past couple of weeks, although that does seem to be easing now. The third hot topic for the week, related to everything else, is that the dollar continues to be incredibly strong. So this is a monthly chart, and we can see that the DXY, the US dollar currency index, is sitting at a 20-year high. And this creates all kinds of problems. I've spoken about some of this previously in other videos, and the media seems to be raising these concerns now. We can see that the ICE US dollar index, which measures the US dollar against the basket of its biggest trading partners, has risen 14% in 2022. and is on track for its best year since 1985. Now, the problem with a strong US dollar, it does help the US in some ways. It cheapens their imports, but people are likely to buy less from the US if the prices are too high and source their goods elsewhere, or just pause buying totally, which eventually will affect the US economy. But probably the bigger issue is for all of those countries outside of the US that use dollars in one way or the other. Either they use them for trade, maybe they're buying things from the US, energy or food. The price of those things go up, and through this year some currencies have devalued significantly against the dollar. This article also talks about the fact that emerging market governments have $83 billion worth of debt coming due by the end of next year. And so if the dollar has strengthened against your currency by, let's say, 20% by the time that debt becomes due, that means that the amount that you need to pay in your local currency for that debt has also increased by 20%. And so you need to find that extra money somewhere in your economy. And this usually means some kind of compromise somewhere else within your government funding. Now, the dollar strength has been fed by a few things. First of all, rise in interest rates in the US means that more people want to invest in things like bonds in the US, and they need to buy dollars to buy US bonds. But also the dollar is considered a safe haven. People know that the dollar rises in times of economic uncertainty. And right now, because the outlook is a little grim, people are buying dollars because the price rises. And because they buy dollars, the price rises. And so it creates this feedback loop of an appreciating dollar. If the dollar continues to remain strong relative to other currencies, we could start seeing issues for other countries around the world, particularly emerging markets, which are more reliant on the dollar than other leading economies. The fourth big ticket item of last week was the FedEx profit warning. FedEx shares plunged by an enormous amount when they announced that earnings were going to come in weaker than they had expected. I think earnings are due for the 22nd of September, and also they withdrew forward guidance for the 2023 year. So the day following that profit warning, the shares fell 21.4%, making it the largest one-day drop for the stock since 1978. Now, this profit warning, together with the drop in the share price, sent a shockwave through the rest of the market towards the tail end of last week, and this is for a few reasons. FedEx ships stuff for many companies around the world, so it has exposure to many different types of industries. And if FedEx is seeing weakness, it means that there is probably weakness across the board in these various industries. So now, globally connected economy, it wasn't just other shipping companies that fell along with FedEx. It was those that were fairly tightly bound to shipping. So for example, it was the retailers and e-commerce companies that also were particularly hard hit. In addition to this, it was the payment companies that those retailers and e-commerce companies use. Because if there is weakness in the downstream companies, the companies that ship your products, there is probably weakness in consumer demand. So those people aren't buying as many things on websites or in store, they aren't paying for as much stuff. And even further upstream than that, the manufacturers of the things that consumers buy and are shipped are probably not seeing as much demand, as many orders coming through. And so the market has taken this as a warning, potentially, for that entire supply chain of companies. Is FedEx the first of these companies to issue such a big profit warning? And is this the beginning of a cascade of other businesses that will do the same? And so the market through late last week was trying to front run additional profit warnings that we might see through the companies that make up those supply chains. However, there is a counter argument. FedEx's share price wasn't doing very well going into 2020. This was pre-pandemic, of course. The company wasn't doing fantastically. So if FedEx has mismanaged their business quite badly through the past year or two, then the warnings that they're issuing right now don't reflect what we'll see in the wider market. I suspect the truth probably falls somewhere between the two extremes, and I do think we'll see companies downgrading their forecast earnings probably through the next 6 to 12 months, but they might not be as dire as FedEx's particular situation. You can see that they're taking some pretty extreme actions in this highlighted paragraph in order to reduce their costs while they ride out this storm. And finally, the fifth big item for last week is the R word. The risk of recession within various countries has now spread, and now we're looking at a risk of a global recession in 2025. On screen, I'm sharing an article from the World Bank, and effectively what it's saying is that the vast majority of countries are hiking interest rates at the same time very aggressively, and this is something that is quite rare. It also says at the same time there's a lot of financial market stress. GDP growth is really starting to slow down now. And in more ordinary times, perhaps when inflation wasn't as high as it is right now, we would expect that these central banks would start to pivot, start to become a little bit more dovish. However, these central banks don't really have room to become more dovish right now because rates were very low until recently. And on top of that, inflation is something that it is a material problem that is making people poorer that needs to be overcome. So the issue that we probably are going to face in the near-term future, somewhere in 2023, is that the actions of these countries behaving in a very similar way will probably compound. It won't happen quickly. There's a lag between when these actions are taken within those countries. And this is part of the fear around, is the Fed hiking too quickly before the effects of the most recent hikes are felt in the economy? And that's just one country. But also because our world is so connected, will the combined effects of all of these countries behaving in this way compound to have a larger effect than we anticipate somewhere through next year? All right, so not the most optimistic week last week. Just a few other quick items. I'm not going to run through tabs or go into detail around them. So US auditors have landed in Hong Kong to start auditing Chinese companies that are listed on US stock exchanges. That's a good thing. Hopefully they'll be allowed to do what they want to do. I think there's still some negotiation in the details of the process there. Ukraine is making some progress in the local war against Russia. Has the tide turned? Are we any closer to an end of a war? Nobody really knows. China's massive lockdown is easing. It seems as though the turnaround in the lockdown from start to finish is probably going to be somewhere in the range of 2 to 3 weeks. We've seen prominent business personalities call on the US Fed to slow down the rate of interest rate hiking. And we also saw some pretty big drops in the price of natural gas, particularly within Europe. And we're also seeing the price of lots of other commodities drop, signaling that market participants think that there's going to be a pretty big drop in demand because of a recession. And what about the week ahead, the week that we are currently in? Well, the UK is closed for business today. There's lots of interesting macro data coming out this week, but the market will be laser focused on this meeting, on this data point, where we learn the Fed's interest rate decision. The consensus right now is that we will see a 75 basis point increase, so 0.75% increase in that interest rate, although the market has semi-priced in the chance of a 1% increase. I suspect if we get a 75 basis point increase or less, because there is a chance that they start easing off a little bit, but I don't think it's a high chance that the markets will be okay. However, if we see a 100 basis point increase, I think the market will be shaken a little bit. Outside of that, we see some interesting inflation data coming out of various economies, and we also see interest rate decisions out of other important economies on Thursday. All right, that's it for this week. I hope you found it useful, and I'll talk to you soon. Goodbye.